Hello, I'm Kamyar Rezaie, and this is Minds of Commercial Real Estate, the show that takes you behind the scenes of the dynamic world of commercial real estate. As a commercial broker to high-profile clientele in Southern California, I've grown a deep passion for the real estate industry. And in this show, we'll be exploring all things commercial real estate through conversations with some of my close friends, colleagues, clients, and partners who share my passion for the business. Thank you for joining us for this episode. Please remember to give us a thumbs up, subscribe, and of course, leave comments with any questions or thoughts you may have about the show. I'd love to hear from you. Hello, thank you for being on the show. Today I have Chris from Harvest Bank.
Hey, thanks for having me.
Good.
Appreciate you. Appreciate you invite.
Thank you for being on the show. We've done a lot of good deals in the past and more to come in the future. Harvest has a very unique line of products, which a lot of other banks don't offer. And that's why we've been able to do a lot of deals together. Mm-hmm. And your primary focus is on SBA loans.
Correct. Yeah, we do mostly focus on owner user financing. Part of that includes SBA 504 product and the 7A product. We also do owner user conventional. We also have a small subset for investor loans as well. We are a non-bank lender, so we offer off-balance sheet type products where we take the loans, we underwrite them, we fully service them, and we're able to do loans faster, quicker, have a little bit more flexible credit box, and underwrite to different policies. So that's kind of our guidelines and the product set that we use. So mostly owner user.
So why would a person that can go to a traditional bank or retail bank and they don't get approved and they come to you guys, they get approved? How does that work?
So typically what I see from customers, there's three driving forces. One is a credit issue or credit flexibility. They might have had a hiccup in the past, maybe was a foreclosure 10 years ago, and the lender might not want to lend to foreclosure clients. It could be a credit issue where that they have had a run-in with a type of cash flow through their business and it doesn't meet the debt service requirements. The other is timing. Sometimes they get down the line, and in the current lending environment, we see a lot of loans that are about to go to funding and they pull them back for one reason or the other. And that brings to the final reason. It's usually an appraisal, an environmental, some sort of flexibility on the third-party reporting that we might be able to get around. However, we use a standard policy across all of our loans, but we're able to look at things in a different lens.
Okay. Let's speak about a little bit on the SBA projection deals that we've done together. Mm-hmm. How do those work?
So SBA projection, what we do is we look for 24 months of financing or 24 months of projections. We're able to qualify the loans on a stated projection income and expense basis. So what we have is we have the customer outline 24 months of projections along with assumptions, and assumptions are very vital to this as well. Anyone can write projections, but you really have to quantify the projections with some language and how you're going to do it. So we can qualify them and approve them on 24 months of projections, as well as look at arrears and look into the past history of their business. But let's say they want to do an expansion and they're buying another building. Well, their current cash flow is not going to cover that. So what we do is we say, give us 24 months of projections, you're going to ramp up and you're going to be able to meet the debt service requirements in the future.
And those projection-based deals are based on the SBA 7A.
You can do them 7A and 504. 504 typically is a little bit more difficult, but the 7A is, we have a little more flexibility with the 7A. So we're a delegated lender. So we have the authority on behalf of the SBA to underwrite and approve the loan. The 504 actually goes through the SBA itself. You can do them in both product sets. It's more prevalent on a 7A product than it is on the 504.
With the 7A, you guys completely underwrite the whole loan versus on the 504, you would sit on the first position and you would have a CDC involved on the second.
Correct. Typically on the 504, there are two loans. There's a first trust deed, which is the lender like Harvest, or it could be U.S. Bank or Bank of America. And the second trust deed is the CDC, the Certified Development Company. And that's the actual SBA loan, which is approved in the case of California in Sacramento. So they send the file up to Sacramento. It gets approved by the SBA. And then that loan is taken out and becomes part of the product set, the first trust deed and the second trust deed. The 7A is one loan, and we underwrite that loan. We fund that loan, and that's the major difference between the two.
Now, on the 7A, typically you guys have a 3-year prepay, right? A 5-3-1?
Yeah, there's 5-3-1, 5%, 3%, 1%. After that, it goes away. It's 25-year, fully amortized, which means there's no balloon payments. The nice thing about that is when we have looked at it financially, if you can pay up to 25% of the principal balance each year without a prepay, so if you really have a good cash flow, you can accelerate your payments and really reduce your principal. And then after 2 or 3 years, you refinance, you get some good tax returns, and you go get a fixed rate product at maybe a little bit lower rate.
And how is that prepayment calculated?
That's out on the outstanding balance.
So 5% of the outstanding balance.
Yeah, at time of payment, it's 5%, 3%, 1%.
Now, we've probably right after the COVID time, you guys had a good round of business increase. How has the business been in 23 and 24 for you guys?
It's been great. We've seen a lot of business uptick primarily because of bank turndowns. A lot of banks have gotten, with the fallout of Silicon Valley Bank, gotten a lot tighter with their underwriting and have become more stringent. And so we see loans that are 2 or 3 months old. They've gone through, we're going to do it. They back out. We're able to come in, underwrite the loan, and perform and get it funded so that owner user can save their business or save their building or get to that building property that they really wanted.
Now, if you have a client like that that's gone to a bank, let's say 2 or 3 months, and it falls out, and they have a current appraisal and environmental, will you guys transfer it and be able to use it?
In most cases, yeah. As long as it's someone that we'd like to have them on we have a qualified list. On the environmental side, we will take it as long as it's a clean phase 1. We're going to take it on the if it's a purchase. On the appraisal side, we'd like to have it from one of our approved vendors. We have a lot of approved vendors. If that doesn't work, we can go and have a third party review it, make sure it's up to snuff, and we'll take it.
Got it. Now, what about on these SBA loans, either an expansion or replacement of a current location where there's construction involved for the new building?
Yeah, sure. So there are two. You can do ground up construction, or you can do tenant improvements. We typically don't do ground up construction. That's just not our cup of tea. We will do tenant improvements. You want to move into an office building, got to knock down some walls, put it in a restroom. We'll do those, and we'll just set aside a reserve. Typically, we like to see them done within the first 12 months. So we like to see 6 to 12 months of tenant improvements, and then you have your loan after that. But we can do that on a as is and as completed value. So if you think your building's gonna be worth more after you're done, so you do the improvements, we'll lend on that, so we can give you the money to do that.
And when a TI or construction is involved, there is a bridge loan which you guys partake on the second until the SBA comes down and pays you guys off.
Correct. Yeah, the way it works is on the SBA 504, there's really 3 loans. So the first trust deed lender, let's say it's Harvest, we go in, we do the first trust deed and the second trust deed. The second trust deed, well, let me back up. The capital stack typically is 10%, 10% equity injection, 50% first trust deed, and a 40% second trust deed. When the loan is funded, we'll loan our 50%, and then we'll do a bridge loan for the remaining 40%. The SBA then will take out our loan on average between 45 and 60 days thereafter. So they actually have the authorization, but in order to get the funds, they have to go sell those bonds. They go out and take all those bridge loans, take them out, and then they become permanent 25-year fixed loans. So there's actually 3 loans. It's a little bit complicated, but that's the way it works. So 99.9 times out of 100, you're going to have the SBA taking out your second trust deed or your bridge loan for a second trust deed.
So even in going back to the one where a client has a construction aspect, either being TI or ground up, the complete project, they have to input 10%. So if they're buying a building, for example, $2 million, the construction aspect is $500,000, our total project cost is $2.5 million. So the client only comes in with $250,000.
Yeah, more or less.
10% of the total project cost.
Yeah, that's going to be, is that the completed value?
Correct.
Yeah. So it should be about that. It depends. I mean, it depends on the product type. Are there projections involved? If you do a projection-based loan in the SBA, they're going to knock it down 5%. If it's special use, knock it down 5% on there. So it could be, 35%. So they might have to inject 15% versus 10. It just depends on the product type and the business.
So we've done an SBA hotel deal in the past.
Yep.
Which a lot of people are not aware that you can do a hotel deal via SBA. Please
Yeah.
on that.
Yeah, it was a boutique hotel. It was 10 rooms. The operator was an extremely good operator, and he's been able to sell this product type in the specific area, which is in Palm Springs. And we like to see people that have good ownership records. So we typically would like to see flagged hotels. So it's going to be, like your Days Inn or your Hilton. But if someone's got a property that's unique and it's in a good location, we'll definitely look at it.
And then once we still have the limitations on the SBA, but he was able to obtain other hotels as well via the SBA financing.
Yeah. So you get up to $5 million of SBA financing. And that's $5 million of 7A money. But if it's the 504, it's $5 million of debenture money. Correct. So that's second trust deed. So you can, if you do typical equity injection, that's 10, 50, 40%. You can buy a $12.5 million building. Now, if you're a manufacturing company, you actually get $5.5 million. And if you do it again, you get another $5.5 million. So they have less restrictions on manufacturing, and there's also a green program. So a lot of hotelers will do this. They'll have $5 million they've spent. So let's just say I have two hotels. One had $3 million, the other one had $2 million. I don't have any SBA money. Well, they can go buy a new hotel. They can make it quote unquote green. They'll be allotted another $5 million. And so there's qualifications in order to make it green.
And there you can go up to 3 green programs, if I'm not mistaken, after the first set.
Yeah, that's right.
So tell us more about Harvest. When did it start and how there was a lot of experience, ownership, principles, and people like yourself that have made it grown into a successful business, and the trust and the customer service has really partaken.
Yeah. So we're the genesis of Harvest is it's a core group of individuals that had worked at a couple banks prior. It was started in 2016. We were able to purchase an SBA license. Once we got that license in effect, we hit the ground running. We have a hedge fund behind us. It's Medalist Partners, and they're a big hedge fund out of New York City, and they provided the initial equity. So with that, we've been able to use the 7A product and use a securitization method on our conventional and our 504 first trust deed. With that, we're probably over 150 employees. I have no idea. It seems like we're hiring every day. But we're really trying to spread our wings right now, particularly on the conventional side. The faster you can get that money out, you just need to keep rolling it. That's kind of the key. So that's the genesis, and we're based out of Laguna here in Southern California. So it's great. You can call me up, call our servicing. We've been flexible. Someone needs to, alter their payment a couple days, so they can talk to someone. So that's the nice thing about working at a company like this. It's very family oriented, and everyone's known each other a long time. We like to have fun too.
Well, obviously, we've worked a lot of, good deals, and looking forward to working more deals. I recall during the COVID era, you guys provided a lot of the PPP loans to help your current clients and other clients out to get them through the struggle.
Yeah, we did a significant amount of PPP. I have no idea how many we did, but we did a ton. And I don't really know much about that program. I didn't really do much of that. I kind of just did it as ancillary type of, but we were set up with some other providers, and we processed a lot of those. But we were able to that helped us through those lean years of COVID because no one was doing any commercial real estate loan. No one knew what was going on. All the businesses, I mean, a third of the, the restaurants, the hotels, all those were shut down. And so we were able to provide the SBA, since we have an SBA license, they looked upon us and other SBA lenders too, say, hey, can you, dish out this money for us? So that's what we did, and it helped.
Now, there are also the current list of clients that you had that needed like deferments and payments and stuff. How did that work for them?
Yeah, it's a good question. So they were allotted a 6-day, being 7A holders or lender borrowers were allotted 6 months of deferment. And then if you were in certain types of industry, so it was a restaurant industry, I think you got another 3 months on top of that. And so essentially what happens is that they just stopped paying. They just didn't have to pay for 6 months. And it was great. It was amazing because it really did help a lot of people.
So it's 0%, no balloon payment?
Nothing. They just don't pay. They don't pay this. So the SBA was paying on behalf of the borrower.
Got it.
So the SBA is on the hook for all those loans. And that kind of goes back to how the SBA operates. They charge a guarantee fee. And so all those fees go into the SBA to make it solvent in cases like this. So if I was the borrower, I wouldn't have to make payments, but that SBA loan might be held by a third party. They still should get their payments because it's guaranteed by the SBA. So the SBA is making payments to that
on their behalf.
Yeah. So it's like up to 9 months, maybe even more. I forget. I'm trying to lure that area out.
So let's hit on that aspect of it, versus going to SBA where there are a little bit more fees for the borrower versus going conventional. There's less fees maybe, but there's more of a higher down payment.
Yeah, I mean, one of the advantages, the biggest advantage of the SBA program is the minimum down payment. So you can put 7%, 5%. It just depends on the lender and the type of program. But with that, the lenders of those programs need to be incentivized. Okay, so what the SBA does is they guarantee part or all of the loan in case it should default. In order to make sure that they can guarantee that, they have to charge fees. So and obviously operate. So you do have a little bit, between 2 and 3%. So you have a little more fees, but you keep more equity on the sideline. On the conventional side, you're gonna have to put down more money. So you might have to put down 30% or 35%, but you're gonna have less fees. Maybe it's only 1% or it's 0.5% or whatever that number is. So it's a balancing act, whether you want to keep your equity dry and deploy it somewhere else, or use it as a down payment and pay less fees.
Got it. And also the SBA has the yearly reporting fees for the tax returns.
There's a servicing fee. Yeah, that's all built in.
Right.
And we service all of our loans. So when you call, as far as, what are you talking about, the tax?
No, there's yearly reportings and they have to provide their tax returns.
Yeah, so not unlike any other lender, we are required to get annual reports, tax returns. So we ask the borrowers, all of our borrowers, to provide the returns after they've been filed or extensions. And then we ask them again. We don't have covenants like other banks have. Other banks will have, hey, if you're underneath a 1.25 debt coverage ratio, we can call your loan. And we have no covenants in those, so it's a little more flexible in that way. But yeah, there are the requirements for that. Yeah.
If you were to get a new client today, what would be the perfect loan that you'd like to do?
Perfect loan, I think it would be a $5 million 7A. Max value. No, honestly, it's amazing. I've helped out a lot of people over the years, and people ask me, because some of our rates are a little bit higher, and I have a great story of this concrete company that I helped, and he had a property here in the valley, and all the workers were pretty local. It was kind of the only development that was able to use the cement making, the rocks, all that kind of stuff that they needed. He was not able to get a traditional loan. I was able to come through, get him a loan, a 7A loan. We went to close, and we all went up and got a margarita together, and he started started to cry. He goes, if I would not have gotten and saved this property, I would have had to move out to Palmdale, to Lancaster. I would have lost all my employees, lost what I have, and wanted to thank me for it. And 2 years later, he got his tax returns filed. He's now with Wells Fargo. He's at the 3%. And it was one of those stories, like, it really does matter. And those loans stick with me. And like, you do make impact on people's lives. And yeah, it's a little bit higher rate, but how can you put a price tag on a building or all your employees that you might lose? So to answer your question, it kind of depends. I mean, I like any other one else, I like to appear alone, but if it matters to someone, I like to do that too.
Right. Well, thank you for being on the show. That was a great amount of information, and look forward to our new deal.
All right. Thanks so much. Thanks for having me.
Thank you for watching. If you enjoyed this episode, please give us a thumbs up, subscribe, share any questions or comments in the comments below, and follow us on social media. I look forward to seeing you next time.